Welcome, everybody. We are at the Collegio Carlo Alberto in Turin for the International Economic Festival. This is the 4th edition, and we are here for a panel talking about a very topical moment in Europe. Europe in the face of uncertainty. So I am Fabrizio GORIA from La Stampa, financial reporter from La Stampa, and ECB watcher. So especially in these times, it's very difficult to assess a perspective for the global economy. We are here with Mr. Pierre Gramegna, Managing Director of the European Stability Mechanism, with Professor Elena Carletti from Bocconi University and Deputy Chairman of the UniCredit Group, and Professor Federico Ravenna, Intesa San Paolo Chair at the Collegio Carlo Alberto, and Professor at the ESOMAS Department of the University of Turin. Good afternoon, of course, and this panel, Europe in the Face of Uncertainty, we want to address to the growing macroeconomic volatility, the global trade fragmentation, and the institutional stress. Over the next hour, we will explore how Europe can strengthen its resilience to navigate the economic uncertainty and the geopolitical one through public policies, through robust financial instruments like the European Stability Mechanism, and the institutional responses. We know actually that the Trump administration, the US administration, continue to fight against the new wave of protectionism with announces, countermeasures, retaliation from China, especially this night, the new round of tariffs on steel and aluminum. And we will try to give response to this uncertainty. I wanna to give the floor to Pierre Gramegna of the European Stability Mechanism. European Stability Mechanism was born in the darkest day of Europe and the Eurozone, and especially this time of uncertainties, maybe the ESM, it could be a stronghold of the European integration and the European resilience. Pierre Gramegna, the floor is yours.
Thank you very much. Thank you very much for the introduction, and pleasure to be here at the Carlo Alberto Collegio. Thank you for inviting me. Piacere essere in Italia. Navigate these uncertain times suggests to me a Japanese word, which is tsunami, which has become world famous since 2011 when a tsunami went over Fukushima nuclear plant, and the whole world discovered what a tsunami can do. How do you navigate a tsunami? That's basically the question we ask. Honestly, I've just improvised this introduction, but I think it gives us a good feeling of what we're facing. There's another way I could describe this, and that would be the following. In the last 6 months and in the last 3 years, talking about how the economy of a country, of Europe, or of a region will go, we spend more and more time speaking not about economy, speaking about geopolitics. This is new. Remember the great financial crisis in 2009, which in the end brought about the creation of the European Stability Mechanism. We were all talking about financial crisis, about interest rates, about spreads, about inflation, sustainability of the economy. It's not that these topics are gone, but they have become a second priority because there's a priority that is above them. You can describe it like a tsunami, which is a sudden thing, but it is more than a sudden thing. It is, since 3 years since the invasion, the aggressive war of Putin in Ukraine, it's a new phenomenon. And that is politics and geopolitics are taking first stage. So all the debates I participate in, we speak about the American external policies, on tariffs, on international organizations. We speak about how China looks at all this. Basically, if you want to see it through that lens, politics and international relations have taken central stage. Because if something goes wrong there, or something becomes unpredictable there, it will have such an impact on inflation, on growth, on peace.
On peace. Like just yesterday, the governor of Bank of Italy, Fabio Panetta, continued to say that the tariffs can undermine the peace, the global peace.
Yes, the tariffs can undermine global peace. And I would add to this, and it's similar, financial stability is a factor of peace. Now, the European Stability Mechanism was there to make sure that we have financial stability in the euro area, so it's the 20 member countries of the euro, and tomorrow, probably next year, also Bulgaria, 21 countries out of 27 that share a common currency are in the euro area and are in the European Stability Mechanism. So it is very easy to take financial stability of the world or of the euro area for granted. In fact, that's what our fathers and founders thought when they created the euro. They thought that European financial stability is a given, and you don't need something like the European Stability Mechanism, which is like a kind of European International Monetary Fund. And then when the crisis hit, we realized that we were missing a piece of our architecture. So, how to navigate that is very difficult. It's unpredictable. And in the specific case in which we're in, we Europeans are squeezed between the Russian war in Ukraine, which is at the east, and our traditional long-term ally of the United States to the west, who is still our ally, but who is a little bit a less 100% automatic ally. So this is a new situation. So it triggers defense questions, we're going to come back to that, which also have an impact on finance, on budgets, and so on. So I'd say that's the big picture. I'd like to add two things to this as an introductory remark. The second one is, what can we do as Europe? What can we do as Europe is obviously do more in defense. We'll probably have opportunity to discuss that, and do more together. It's not only about having a competition of announcing high numbers of billions that we're going to spend on defense, which is important, and we have now a consensus in Europe that we have to do much more than we used to do. We were not even, many countries were not even delivering of the 2% to GDP target of defense expenditures that we promised to President Obama. Yeah. To President Obama. We did
in the first administration.
In the first administration. So it's a long time where we did not deliver, not good for us. But it's much beyond that. We need to do it for our own security. What is lacking in the discussion for the time being, I hope it's going to evolve, is what can we do together? It's not only about having a lot of money available for it. How do we spend that money in a smart way, invest together in projects? Invest together in projects with public money and private money. I would just launch the idea here. What does the EIB do? They cannot invest in defense products and so on, but the scheme, the setup of the EIB is very interesting. European Space Agency, we have lots of interesting agencies in Europe that could serve as a model, not necessarily just where is the money, but how do we do it together. The second thing in Europe that I would like to underline, and then I have just one other point, is we have an opportunity here. We have an opportunity here, we might have the opportunity to discuss it more, that the safe haven status of the dollar is starting to be questioned by markets. So we have an opportunity if we do our homework. What is our homework? Our homework is grow more. In the last 10 years, Europe has grown half the rate of the United States. If you go farther back, it's even similar. So we're growing slowly, innovation is too little, so we do not invest enough, and we are the area of the world that has most savings. So how to implement a savings and investment union that the Letta report and the Draghi report call for, I think is really a solution to the problems. And that's in our own hands. So it's not sufficient to complain about the uncertainty and what's happening outside Europe. We should do our homework. Third point, at national level. At national level, if you look at the elections in the last 2-3 years in most European countries, to say it bluntly, very often the extreme right parties, very often nationalist parties, are big winners. They're not necessarily in government, but they're the big winners. So people are starting to think that Europe is not the solution. So we also need to do our homework in internal politics. Because if what is happening in terms of uncertainty outside Europe, and mainly in the United States, but maybe in other areas of the world, so then we need to make sure that our citizens understand that we are living in a world that's more and more polarized. And if it's more and more polarized, well, we need to concentrate to strengthen our area of the world, Europe. And for me, and I say it again very simply, in such a time where wars are starting everywhere on the planet and close to home, when we need to stick together more.
And not only wars on the field.
Yes, and not only wars on, yes, economic wars and so on, and tariffs is part of it. And so for me, the solution is more Europe and not less. Because in front of the rest of the world, if we're not united, I do not think we have any chance to resist it unless we will, all of us, all countries taken in a single manner, become irrelevant. So it's a bit provocative what I say, but maybe that's good for the debate.
No, it's good. It's crystal clear. Professor Carletti, what is the concept of resilience in the Eurozone today? Mr. Gramegna, the managing director of the ESM, talked about the role of financial institution, the systemic risk for the Eurozone concept in this multipolar world. Christine Lagarde, for example, the president of the European Central Bank, talked a lot about the poly crisis. We have some bubbles of crisis everywhere: private credit, the de-dollarization, trade wars. What is your point?
So first of all, good afternoon to everyone. Thank you for the introduction. Thank you for the invitation to the festival. Before I start, I just want to say I'm here as professor, so in no way I am representing the views of UniCredit Group in what I'm saying. Although it's not related to consolidation or anything, the discussion today, but I think we leave that on the side. So what does it mean, resilience, first of all? Well, resilience means the ability to withstand the shocks. And the shocks can be of different nature, and who have the ability to withstand the shocks is the financial institution, the financial market, the political institution, the economy overall. Now, because I'm a financial economist, I will focus mostly on financial institution and financial market. As Pierre said, of course, what we are facing right now is geopolitical risk, which actually is everything. Goes from wars to terrorist attack to cyber attack. It's really political, trade flows, changes, tariffs, whatever you think of. But whatever you can include in geopolitical risk, all have one thing in common, which is that they create a lot of uncertainty. They're very unpredictable, or at least they're not as predictable, think of wars or terrorist attack, as other type of shocks. And therefore, also when it comes to how to manage them and how to try and withstand those type of shocks, the normal way in which financial market and financial institutions work are put in question. Because normally, how would you withstand the shock? You would do financial analysis, you would know how things have worked in the past, you would have a lot of data, and on the basis of this data, you would try to predict what may happen, and therefore you would try to build defenses, whether it's an economy, whether it's a bank, whatever institution we are talking about. But if you don't know what's happening tomorrow, and what's happening tomorrow may be very, very different. Think of COVID. It's not geopolitical risk, but to give an idea of a very orthogonal shocks to how the world was working, or the Russian war. I mean, the Russian invasion was clearly, I wouldn't say orthogonal, but I would say largely unexpected, at least not to this extent. So how would you then respond? How can you build the resilience? How can you build defense against this type of shocks? So this is why I think dealing with what we are dealing now is so difficult, because we don't exactly know where this bubble may be coming. We don't know tomorrow what may be happening. And we don't have financial data that help, for example, financial institutions to deal with this. So having said this, which is of course not very optimistic.
Yeah, I remember, for example, the crisis of the regional banks, the US regional banks in 2023. There was basically a bubble that was busted.
Yeah, but if you allow me, the crisis of 2023 in the US could have been more predictable.
Yeah, for sure.
I mean, the fact that the Fed was raising interest rate,
yeah,
and
they
were not worrying about the value of the long-term asset or what may have happened on the deposit side, in that case, that was really, I mean, that should have been predictable.
And now
at least
we are in
a
the
bit
time.
more than a terrorist attack tomorrow morning.
Of course, yes.
There is
now,
no comparison.
Now, especially the economists, the Nobel Prizes continue to say that Trump is unpredictable.
Trump is unpredictable. I mean, one day he says we have 145% tariffs. 2 hours later it says, oh no, we wait for a month. The day after it goes from China to Europe. How long does it last in Europe? Maybe 1 day, and then he goes back and he gives 90 days. So this is the sort of unpredictability and volatility that he's creating. So when you have such a volatility, on the one hand, volatility can also be an opportunity. If you look well, you have to be professional enough to exploit this volatility. But if you are professional enough, look at the first quarter result of banks. They have made huge profits on trading because they were anticipating, they were a bit maybe, you can exploit short-term volatility. But the volatility that is introducing is really big. And maybe volatility is an opportunity in financial market, but volatility is not an opportunity for the real economy because you don't know how to invest, you don't know what to invest, you don't know what to do. And nowadays, if a firm wants to go to a bank and ask for a loan, and it has maybe more than 10% of its own business sales in the United States, it's not so clear that the bank will not charge a higher rate. Because the bank doesn't know what to do at that stage. It doesn't know whether tomorrow the business of the same firm is going to be as profitable. It doesn't know whether the firm has to look for another market. So that is the uncertainty that is creating, and ultimately is sort of paralyzing. So in the financial market, there is volatility. To some extent, if not too extreme, it can be an opportunity for professionals. Let me say again, I think retailers have not the same opportunity, and therefore is not positive. As long as we don't have huge fluctuations in foreign exchange because of the dollar situation, we don't have US treasuries defaulting or not even close to defaulting. So as long as it remains a short-term volatility, it can be managed. But the real economy is completely different. So as I said, there is an increase in credit risk, perceived credit risk, because again, there is no way in which we can evaluate what the credit risk of companies is at the moment. And we're talking about companies that until 2 months ago, they were very profitable and they were maybe having business with the Western-friendly country. We are not talking about firms having business with, let me say, Russia or I don't know, the typical unfriendly, in quotation marks, country that you can think of. These are not the type of firms that we are talking about. So this is the extent to which credit risk is coming back in an important ways. Now, what is the positive side of all this? That after COVID, after the Russian invasion, the financial institutions have learned to do much more granular analysis, monitoring portfolios, look at sectors, and therefore they are better equipped at least after some years that we are having the non-possibility to rely on financial data. They are better equipped to follow at least and understand a bit better the conditions of the companies.
Especially on a daily basis because of the Trump announcements.
Well, having real-time data in banks, we are not talking about Apple or Google. I'm afraid that we are not there. But in a way, they have learned. And the sectors that, apart from metals and others, we're talking about the same sectors, basically. So they have a knowledge of the sector specificities that will certainly help. Let me say one more thing, and then I leave the other colleague speaking. There is one other thing that all this is creating, which is safety. We're talking about peace, but also non-financial risk that goes under the name cybersecurity. So that is also an important element. We have already seen an increase of it with the Russian invasion. Clearly, this has been a recurrent topic. But now, because of these geopolitical changes in alliances, and we don't know who is friend and who is not friend anymore, of course, this risk also goes up quite significantly. So that is something that we're not used to talk, at least not in the financial discussion, but is also very relevant.
It's really topical. Yes, thank you, Professor Carletti. Professor Ravenna, what is the credibility of the fiscal tools in a high-depth political fragmented landscape? I mean, even yesterday, the Governor Panetta said Italy, for example, needs a stronger fiscal consolidation. We have growth, actually, anemic growth, I can say, but we need to reduce the debt rate to GDP. So what is the credibility of fiscal tools in these uncertain times?
So first of all, welcome to all the guests of the festival. I'll get to the question. First, I would like to say that we all, including me, we came here hoping to get some answers for the current instability, and for now the only certainty that we have is that things could go very wrong, and they could go more wrong than we expected in the past. And being an economist, I try to attach numbers to how wrong things could go. And I prepared some numbers, if they could be put up on the screen. If not, I'll tell you the numbers. So the difficulty of our time is that we are faced with events to which it's hard to attach probabilities. So it's hard to make assessment of how bad things can go. That's the real challenge for all of us. That's why we're starting, it was economic risk, and then it became geopolitical risks and energy supply risks, and then you had climate change risks. We are very good at facing recessions, or risks to which we can attach probabilities. So we're not very good at preparing ourselves for risks which have not happened in the past. So I discussed with my colleagues and econometrician colleagues like Professor Petrella, Professor Gambetti at the college, and then I discussed with central banks, and we came up with an actual model that could tell us what happens on average, what to expect under a couple of scenarios. And I wanted to share with you what's the difference between having the US being in a strong expansion, as it has been in the past 2 years, driven by technological growth, and an expansion driven by excessive deficits or loosening of financial regulation, for example. And I put these two forecasts for 2025 and 26 up to 27 up in this plot. And one is more volatile, but overall the average growth would be about the same number in the European Union. So we're asking, what is the impact for the European Union? The part that is worrisome to all of us is what is the risk that things go wrong. So we could, looking back, so without including the possibility that the trade relationships could blow up in a major way, we asked, okay, if we look at past data, what can we learn about the risk that there will be a recession, for example? And these risks, so all the other possible paths which are less likely, are the ones in the shaded area. So what is the risk? So if we look at a good expansion, an expansion in the US driven by strong technological growth, then the risk that we end up in the European Union in a recession in 2026, it's about 10%, so that's 1 in 10. If I look at the other possibility, the large excessive deficit, high inflation in the US, what matters is not so much what's the average growth, but in the blue shade, that now the recession risk has increased to be 1 in 4. So now there is a 25% probability that we'll end up in a recession in the year 2026 and 2027. So that's what we're discussing today. Even netting out major bad events, peace talks that break down or trade flows that get completely disrupted, even netting that out, the data tell us that the current policy situation in the US is bringing to us a lot of risk that things will go very wrong in the euro area. Now I want to say another thing about the numbers. These risks, this is what could happen. But the fact that this chart, this shaded area is so large, means that there is more uncertainty. And more uncertainty does damage already today. So the fact that banks, financial firms, manufacturing firms, households perceive that there is more uncertainty translates into different decisions already today. So if you think that you could lose your job with a much higher probability next year, probably you are going to save more this year, or you are going to postpone the purchase of a new car, new fridge, new washing machine, and that creates damages for GDP already today. And you could estimate those numbers also, and we've done that, and we computed that a disruption such as the major disruption in EU energy markets after the eruption of the conflict between Ukraine and Russia. So an increase in uncertainty of that size would lower industrial production in the euro area by 3 to 9% in a year. So already, because there is uncertainty, we're losing GDP, we're losing employment today. So now we have two problems to face. One is how to get ready if things actually go wrong, and how to prove to the economy, to all the economic agency, that we are ready so that this uncertainty is reduced and people can invest with confidence and GDP doesn't fall already today. So we're facing a very, very complex problem, of which the fiscal part is a major element. Maybe I've talked already a lot, so why don't we take up the fiscal institutions in the second round? I'll do that.
Thank you, Professor Ravenna. I wanted to go back to the managing director, Gramegna. During the great financial crisis, the ESM was the stronghold of the financial stability. Everybody was looking at the Luxembourg for the financial stability and the safety net of the ESM. Yet, this is for the audience, Italy is the last country that have to ratify the reform of the treaty. I'm not asking about the Italy in this event, but why the European Stability Mechanism is still the cornerstone of Europe's financial architecture?
Well, I will obviously answer this immediately and then maybe give a broader view on this. First of all, it is important to realize that the European Stability Mechanism was set up in 2012. Italy is the third largest shareholder with 17% of it, and the ESM is up and running and functioning. What is not happening is that the amended treaty has not been ratified by Italy. Out of all the countries, it's the only one. And so there's one element which is the backstop to the Single Resolution Fund of banks. I'm looking at Elena here, which cannot work. So it's interesting to underline and then I will grow out of that topic something else. That's bad news because the Single Resolution Fund has 80 billion euros collected and paid in by the banks themselves. So it's bank money. Then you have the additional backstop of the European Stability Mechanism, which is now earmarked for 68 billion euro, which are there. They're earmarked but cannot be used. Now you might say, well, it's not so terrible. Now the Silicon Valley Bank failure alone was 150 billion euro, one single bank. No, it's not a small bank, but still. So it's a pity we don't have it for two reasons. One is we don't have that additional safety net which was foreseen. Second, it means that it's taxpayers' money that eventually has to save banks in the future, and that's exactly why we did all this, that when banks fail, it's not the taxpayer who has to come up with it. So that was the rationale. So that's in the air, it's up there. We hope that one day Italy is going to ratify for the benefits of all banks, including the Italian ones, and for the whole rationale of not having taxpayers' money being used.
Oh, the whole banks and also the real economy, because
sure,
they have to, the banks needs to, send loans to
sure,
consumers.
So it's, yeah, it has also macroeconomic consequences. Yeah. The indirect consequence is, and that I think is even more important. The Letta report, the Draghi report, they tell us what Europe can do to grow more. So it's to look at the optimistic side of things. We have been resilient after COVID. We have had one special good year, 2021, but apart from that, we have a growth of less than 1% in Europe. It's not enough. We need to mobilize capital to have more investments in innovation. And we could do that if we deliver on the Draghi and Letta report suggestions. Modernize the single market. The single market was agreed in 1993. In 1993, if I'm not mistaken, Google did not exist. So you understand, it's not that the single market was not smart, it was the smartest thing we've ever done in Europe. It's just that you need to update all of that. It's one example amongst hundreds. So we need to do our homework in order to generate more growth. But having been sitting around the Eurogroup since 2013 as a finance minister and now as ESM managing director, it's a very complex topic because everyone has vested interest. Every country has. Every country has. So this non-ratification of Italy is not conducive to having constructive attitude by other countries. So it slows down the whole progress we must make, and we must do it more quickly than we have ever done in the past. So it just triggers other vetoes. So if Italy does this veto on this, another one will do a veto on Eurobonds, another one will do vetoes on something else.
We could say this is a loss of credibility for the entire Eurozone?
Exactly. And so we must really overcome that in this geopolitical situation we are in. I said it very bluntly, we need more Europe than less. But I can also phrase it differently. We have the chance, the opportunity and the credibility to be the area of the world where the rule of law, the belief in multilateralism, the belief in the World Trade Organization, so a whole framework that surrounds world trade, is there, and we defend it, and we abide by those laws. And the majority of countries would like to keep that. Now, the largest country in the world wants to step out and has stepped out of it. The major engine of growth in the past 30, 40 years has been international trade. So Kristalina Georgieva, who is the managing director in the IMF, every year I've been going there since 2013, every year she says, no, international trade is, so it's a long tendency. It's not only the last 2-3 years. Yeah, international trade used to contribute 5-6% to world growth. We're to less than 3%. So the less trade we have internationally, so I'm talking here worldwide, the less world growth we had. So we are the beacon of organized free trade. We are the beacon of liberties. We are the countries where all these liberties were invented. And I can tell you, I see that as European institution, and I hear that from my colleagues, the ministers of finance and prime ministers of the European Union, all the countries are looking at us, from Canada to Japan, from New Zealand, Australia to Southern America and the Mercosur. They say, you will hold to it. You are going to play by the rules because we want to have a world where we play by the same rules and stick together. So this is absolutely key. And do not underestimate this understatement with which the American administration describes the attitude of the United States. They want to be transactional. Now that sounds like you buy a car, you have a transaction. The car is 30,000, you want to pay 25,000, in the end you agree at 27,500. That's a transaction. If you are transactional at countries level, who wins? It's always the strongest.
Well, actually there is a very incredible sentence from the 30s, beggar thy neighbors.
Yeah, that's what it is. So it is extremely dangerous if it boils down to everything is negotiable and everything can be object of transaction. If you're small, and we Europeans, even taken together, we're smaller than the United States, we're a smaller economy, we're less productive. In terms of defense, we're weaker. In fact, we cannot take care of our own defense ourselves. So going from a mode where you have an international framework to a world where it's based only on power is a very, very dangerous evolution, not only for Europe, for the rest of the world. So for that, I would like to commend the Commission of the European Union, which is being attacked very often everywhere, not only in Italy, that they have done an excellent job in the last 6 months in 2 ways. Opening up to other areas of the world to do free trade agreements. Mercosur is one example, and lots of others. And second, saying to the United States, we're not eager to retaliate. They did not say, we don't want to retaliate. Just saying, I mean, this is not the game we're in. It's in the best interest of both of us, you, the United States, and us, Europe, to avoid tariffs. Because having tariffs is a lose-lose. And last but not least, and maybe Elena or Federico can comment on that, all the studies show, we have done it also at the ESM, if all these tariffs, or part of them, are being implemented by the United States, it's going to hit the United States twice as hard as it hits ourselves. So it's even a lose-lose for them, which is stronger than for ourselves. Now, this is all rational, what I say, but obviously rationality is not what guides all this, and that's what makes it so unpredictable and uncertain. And then maybe just to say to Helena that she said that fortunately banks are resilient. I started with talking about the absence of ratification of the backstop. Yep. So fortunately banks have had 2, 3 very good years so far. And even on short term, they can absorb these risks and even make money with it in the short term. But let's not lie to ourselves. This uncertainty, and that's the key element, and I'll stop here, don't want to be too long. Uncertainty will reduce investments in any part of business. And you have more savings, less investment, less growth, vicious circle for us. But vicious circle for all, vicious circle for trade, and in the end, it's a lose-lose game for the whole planet. So that's what is at stake, and that's why I would encourage you to all those of you who are interested in all those, look at all the interest of the rest of the world in having commercial partnerships with the European Union or between Asian countries among themselves. There's even a discussion, I'll stop here, amongst China, South Korea and Japan to do a free trade zone. Had you told me this 6 months ago, I was ambassador in Japan, I would say you're a complete dreamer, this is never going to happen. It happens because somebody's shaking the tree and everything, so other things become possible. So I'm still optimistic.
That's great. I mean, the optimism in these times is positive. It's terrific, actually. Professor Carletti, we talk about the credit risk. Especially the Bank of International Settlements, the BIS, continue to say, and also the European Central Bank, continue to say that non-financial banks, non-financial institutions, sorry, are major risk for the Eurozone economy. In this context, probably the European Stability Mechanism can do more in order to stabilize the markets in the case of turmoil. So the non-institutional, the non-banking institutions are a threat for the Eurozone?
You mean in the non-financial institution or the non-banking financial institution?
Non-banking financial institution.
Well, I mean, yes, of course, because they are less regulated. But in Europe, we don't have so many of them. I mean, it's not comparison. There's no comparison with, for example, the United States, how many of them we have. So in a way, I don't think that at the moment there is too much. Then you may have always bubbles somewhere. But I think at the moment, I wouldn't say that this is the major risk we are running in Europe.
So what is the major risk?
No, the major risk, I think Pierre said it very nicely and said it all. I think the major risk is this geopolitical and what creates. But I think one risk that we have on top of it is the inability of Europe to improve, to become more Europe. I think that is so disappointing and so, in a way, unexplainable, if not with vested interest of each country. And it's each country, it's not just Italy, it's all countries. And what I find, I mean, as a non-ideological economist, let me say, very remarkable is that every country in Europe is subject or potentially subject to shocks. I mean, even the strongest. So if we go back to geopolitical, this risk is not evenly spread across countries. I mean, take Germany. Clearly, Germany is more potentially subject to this risk than others, simply because it has a much bigger export to the United States. It has a much bigger GDP share on the automotive sector, which is one of the most problematic sectors at the moment, even before the Trump, because of the China, of course, competition. It has energy supply problems. So now, not to blame Germany or other countries in Europe, but what I want to say is that we would definitely need an institution like the ESM that can help in overcoming what is called asymmetric shocks. And therefore, that is really what the ESM could play. And this is the tragedy, if you want, of this continent, that doesn't manage to overcome the vested interest and understand that each country one day may be in that position. Therefore, it would be much better to help each other and to create common defenses, common backstops, and something, whether it's for banks, whether it's for fiscal policy, whether it's for everything. So that is what is really, I think, the additional, if you want, a shock that Europe has versus any type of shocks that Europe may be facing. And next week, we go to the ESM for a Saving and Investment Union conference. I really hope that this time we're making progress. But it's all to be seen still. But it's really, and the crisis of the United States and the crisis of the relation is a really huge opportunity for us. Now, if I think only of universities, US universities are freezing hirings. So there is going to be a big influx of American-based PhDs next year on the market to Europe. That would be a huge opportunity. Then we have to think, what do we do with European-based PhDs that are scared to death that all the Americans are coming? So that is another question. But it would be a huge opportunity to repatriate some of the talent that we have been sending away in those years. But we need to create financial conditions, economic conditions, working conditions in Europe to welcome all this and to foster all this.
Do you think that we have, as Europeans, the strength, we are strong enough in order to attract talents from Harvard, for example, Columbia University?
Well, in Bocconi, for example, we discuss this every day. First of all, we discuss the possibility to give hospitality to foreign students that may no longer be in the United States. So we have very close ties with Harvard, for example, and of course, given all the crisis that is happening, we are thinking about potentially doing something. But in general, I think we should be prepared to hire people in the future, for sure.
Professor Ravenna, let's back for a moment to the credibility of European fiscal tools. The International Monetary Fund, especially on Italy, talk about, okay, you have growth, but you need to consolidate more on the fiscal side. Especially in France, this is very topical in Germany too because of the energy crisis and the automotive crisis. So what can be the role of the European Stability Mechanism, for example, or the other financial institutions in order to, in this context of rising debt and uneven political will?
So, when we talk about rising debt, we mean debt rising too fast compared to the growth of the economy.
Yes.
So there's a way to identify the problem in the denominator. So the GDP is not really growing much. And the IMF even goes in the mission to Denmark, tells Denmark that they need to reduce their deficit and have a surplus. So they're in the habit of going around and having this pro-austerity, pro-consolidation message. There's been a lot of changes in the EU fiscal management and in the treaties, trying to introduce more flexibility, trying to get countries to both have an eye on the deficit but have multi-year plans. And that's a flexibility that's very welcome. It had been advocated for many years to be introduced, to commit countries to paths rather than to yearly targets or sometimes accounting tricks to make sure that they meet these yearly targets. And that's been a very positive development. How it's implemented in the European Union context, it's debatable. Whether the excessive deficit procedure or the multi-year targets, that there's a bit of lack of clarity on which arm of these two sides of the fiscal disciplines are the ones that are implemented as a priority. So that's something that should be resolved, and I'm sure it will be resolved. The second issue that I see is that there is still a very marginal role for what's called independent fiscal institutions. So we have something called the European Fiscal Board. These fiscal boards have been created in many countries. They still only have an advisory capacity. We have a fiscal board also in Italy. But they don't have any standing, really any legal standing to have a very compelling impact on the budgetary process within each nation. And this is problematic. If there's countries, typically, I know the experience of the Nordic countries in Scandinavia where they have a lot of this kind of boards and they generate a lot of commitment device. So I remember we were producing forecasts at the central bank, the Minister of Finance in Denmark. The Minister of Finance would produce its forecast, and then there was an external National Economic Council which would produce its forecast. And we used to meet at some point all together informally because there was no upside from our forecast being in fact very, very different. So if there was a forecast among the three that we wanted to know, is it very different, your forecast? Because then I want to think about what are your different assumptions, if I had the wrong assumptions in my forecast. And this generates exactly the kind of dialogue that Pierre was advocating among countries and among EU institutions. And it's a part of generating a commitment and making sure that there is a cake that we all care about. So we all care that the cake is baked in the right way if we all need to sit at the same table. And of course, the European Union, it's all about creating this governance mechanism, but it's been difficult. I want to mention another example of governance which is really key, which is done well in some countries and less well in others. So in Alberta is the province of Canada where you get most of the currently extracted oil. And oil revenues amounts to between 5 and 7% of Alberta's GDP, which is a very large number. And the government of Alberta established in 1973 a fund, an oil fund to accumulate the revenues so that they could be spread to future generations for the time when oil would not be, the oil reserves would be exhausted. And they accumulated around 20 billion Canadian dollars. Is this a big number? So if you go to Norway, which has more oil reserves, but anyway, they accumulated in the same time 1,700 billion dollars. Why did these countries have very different experiences? Because in Canada, the provincial law was very easy to dismantle, and it was dismantled, so there was not an effective governance, an effective commitment device. So these funds started accumulating major revenues in the beginning, and then the politicians decided, you know what, this is, we need the money to do something else. And Norway followed a different path, and now they are the largest sovereign wealth fund in the world. And they invest in, I think, 93 different countries, they're very diversified. There's no question that this is the right path, and they created the governance and the laws to generate this commitment. The other way in which you can generate commitment, besides enforcing laws and having good governance, is with trade deals. So this is a self-fulfilling, self-enforcing mechanism. The more we create trade relationships across countries, and we see this very well from the experience of the European Union, the more the cost of conflict, the cost of retreating from this trade agreement, the cost even of waging war becomes excessive, and we never want to go there. We always want to sit at the table and think, let's come up with some institutions or some resolution so that we don't have to go to conflict. So this is the opportunity for us as Europeans to build more treaties with the rest of the world. After all, we have also the experience of Brexit. You know, basically, the citizens in the UK, they're paying 2% extra tax every year, which is what they lost with abandoning the European Union. They lost 2% of GDP every year forever. Would you be happy to pay 2% to say, you know, I don't have to bow to these Brussels bureaucrats anymore? I don't think so.
Thank you, Professor Ravenna. We are approaching the end of this session, and we are almost ready in order to open the floor to the Q&A. In 1 minute each other, what is the most important step for Europe in order to boost the resilience in this uncertainty? Mr. Gramegna.
I think that we need our politicians in all countries and journalists in all countries to be factual in treating what the European Union has achieved up to now. 80 years of peace, it's a peace project. We have been able, I say we, all together, all the countries, to answer all the crises that came in these 80 years, including COVID, to mention, and Ukraine. Who would have thought that we can mobilize hundreds of billions in the EU budget to help Ukraine together? So we have showed resilience in Europe. So I think we have a very good track record, not to mention the next generation EU solidarity, which we're able to agree. So we have a very good track record, which is not being well recognized. So that's looking at the past. Your question was for the future, but let's build on that past and say, for the future, in a world that becomes polarized, where there's less international trade, well, our only solution is to boost the internal market, the common market, which is more than a market, like Enrico Letta says is so well in his report that I encourage you all to read. It's well written. We are more than a market. No area in the world has gone so far in working together as we have done. And I think the track record is excellent, and we have a unique opportunity pushed by the outside, which forces us to work together. Let's build on that, and let's encourage our politicians from whichever side, from left to right, to build on this. Instead of saying that if something in your country isn't working well, it's the fault of Brussels. Let's not find a guinea pig who is responsible for everything. And I didn't know the number Federico, I'm grateful, I'm going to use it a lot, this 2% that you lose by walking out of European Union. It's never mentioned. Going alone, you might go faster, but going together, you'll go a longer way.
Thank you, Mr. Gramegna.
I think he said it all. For me, it's fine if we can go to questions.
And Professor Ravenna, you in 30 seconds.
What I would like to see in my lifetime, building on the success of the next generation EU issuances of bonds, is to see Euro bonds. And I wonder also what the ESM, what's the view? You know, the ESM is a great institution, but it's built to face crisis. It's not built for long-term development or long-term public spending. And at the moment we have one between ESM, EIB, and Next Generation EU, we have maybe 1.5 trillion euros outstanding or as guarantees. The treasury market in the US is $30 trillion. So this is a very small market, but if in Europe we could develop the capacity to have a large market in safe assets with some smart governance, I think that could help a lot Europe to go ahead.
Which is topical, especially for the euro as an alternative to the dollar in this moment. So we have a wake-up call. We had a wake-up call, and we need to boost our credibility in the global context. So let's open the questions. Please, to be concise in the making questions.
Good morning, everyone. I apologize if I speak with this voice, but I had a bit of an illness, and I wish I could speak in English, but I can't, so I will speak in Italian. I introduce myself not because I want to boast, but because I want to let you understand what kind of comment I'm making. I am a researcher of the Italian Ministry from Culture. And economics is culture. I graduated here with Mrs. Fornero. Now, this latent pessimism we have in Italy bothers me a bit, because there are great tools. The two previous crises, the one of the skyscrapers and then the one during the Monti Fornero period, well, at the time, I had invested at 75 instead of 100, and I sold at 130. So, I mean, from 75 to 130. Now, between COVID and the wars, my money, my investments have stayed very low. It is true that if you buy bonds at 59 at very long terms, and I'm talking in particular to Professor Carletti, it is true that you are going to earn a lot, but there are certificates. The certificates, so your question is on certificates? Yes, exactly. Certificates are very good tools. They were created in Germany at the end of the 90s. They got to Italy, and I invest in certificates, and all certificates, at 10,000, they will become 14,000. Then you have the capital gain, but none of them was paid less at maturity. So what do you think about it as a kind of investment? All right, this is a very interesting topic, because Banca d'Italia, during the last... Now, of course, you can... I would like also to hear the comment from the Professor Carletti. And by the way, congratulations for your speeches.
In the Financial Stability Review, the Bank of Italy turned out that the certificates are very popular in Italy, and it could be a major threat for the savings of the consumers.
Careful with certificates. Sorry if I say that. It depends how certificates are constructed. So certificates have this big advantage that you can compensate the losses from the past. So in a sense, they're very attractive. I am with you. But certificate can be structured in a way that is highly sophisticated. It's not true that you can't lose with certificates. It depends on the barrier they have, the underlying asset of the certificates. So if you want to invest in certificate, you have to be very careful which kind of certificate you invest, because they can be a very big threat if, in particular, consumers don't understand how they are designed.
Apologies, but we cannot translate if the question is not on the microphone.
You're not diversifying. You are actually combining risk together. So it's a completely different financial concept.
The other questions? Please.
Okay, thank you. Besides for certificates, that I agree they are dangerous, so one has to be careful. I think what we are discussing here, and I want to say this because all the conferences we have been going through during the festival, we reach always the same bottom line, that Europe has to be stronger and more united. So, I mean, the problem we have today is really a gap in rationality. So we discuss a lot about the rationality of Mr. Trump, but there is an obvious irrationality also in the European design. And when we manage to reach a level of rationality, we never go to the end. I mean, the ESM is a perfect institution, absolutely necessary, that was built during the financial crisis because we realized we needed the fiscal backstop. But before the ESM, the European design was such that bailout of countries was not allowed in the Maastricht Treaty. It was not allowed. And then we built up the ESM, and then we said, okay, but bank now, they really have to bail out for the bank, we have to rule it out, okay, so they have to create their own common insurance with their own funds. And then we realized that all the banks that were saved or closed or during the sovereign crisis, the financial crisis afterwards, were saved with public national funds. So now we say, okay, we need finally an ESM, we need a fiscal backstop also for the insurance fund for the banking crisis, and we need that. But then there is some irrationality that comes in that prevents us to go all the end towards the end. And the banking union, I mean, we lack one pillar. I mean, we have two, but why do we lack one? So there is what do we need to become fully rational? To go against the wall in another crisis, maybe? What do you think, Pierre?
Well, I think you really describe it exactly as it is. Now, the Trump administration has been in for 5 months. I really think this is an incentive for all of us to act. So let's not be too severe here in our judgment. You know, I sit in the Eurogroup every month, and that's the finance ministers. The finance ministers are not the keenest ones for change, but at level, and it's normal, that's their role, but I think the prime ministers are very well aware, or president, depending on the countries, what's going on. And I mean, I could, and it would take us too long, but I could mention dozens of examples of things that have happened in the last 5 months in Europe, of which I would have told you this is never going to happen. So Germany, that's maybe the most important example. I mean, the German government saying, we need to spend more and get rid of the debt brake that is in our constitution. This happened in March, not so long ago. I mean, this is a game changer in the mentality of Germany. It's built on two things. It's built on the coming from the 1920s inflation crisis, that the Germans say, we want to have sound public finances, full stop, whatever the cost of it. Now they see the cost of it is such that we have such underinvestment that we are hurting ourselves. That's what's below it. The second thing is the Germans, which is the country who has always, for understandable reasons, said, we rely on our American ally for defense, full stop. They say whatever they want, they do whatever they want, we trust the Americans. Many other countries said so. Others in Europe were already a little bit more nuanced, but basically could live with that. Now, this is the most important economy, the most important country saying, we cannot rely anymore 100% on America. We need to develop it yourself. I mean, this is a major step. Now, I can talk a lot about European Stability Mechanism, what we can do with the treaty as is, ratified or not ratified, even with the one ratified. This is one instrument, a kind of, we are the lender of last resort. And I think it's important that the public understands we are there, we are the lender of last resort. We are not the European Investment Bank, or we are not an investment agency. We need, if you ask my opinion, we need an arms agency for Europe, where we buy together, we provide together, eventually we develop together. This is not the task of the DSM. If politicians think we can associate that to the DSM, that it can be worthwhile a discussion, but let's also not create the impression in the public that we could eventually do more than what we do. We are a lender of last resort like the IMF is, or like an insurance is in the very last resort. But so let's not be over pessimistic. What has happened in the last 5 months outside Europe is amazing, as the president himself of the United States was saying, just amazing in his word he likes. But he has produced amazing developments in Europe. And I think we should not, it's not that as I'm saying here we should slow down. We should carefully balance how we're going to do things together. And I'm optimistic that this will happen because it must happen. We have no choice. So alarmist in a way, saying, I mean, we have a lot on our plate, but optimistic in what I see on an everyday basis, because the major countries, if all the countries and the major politicians, responsible ones, see what is at stake, and what is at stake is peace in Europe, peace meaning no war, we defend ourselves, and freedom of speech and rule of law. I mean, this was not the topic of our discussions here, but that's what's at stake on the other side of the Atlantic. So we are seen as a beacon of freedom, and I think there's very few who are challenging that, and we want to keep that. So I think our conference here comes at a very, very challenging and interesting time, but I would like the listeners to get the message that everyone is aware of it. And we do not see this already translating in the speeches of all our ministers, prime ministers, and so, but it's in the making. So not everywhere, not all the parties, but it's in the making. I'm more optimistic than pessimistic.
Thank you, Mr. Gramegna. We don't have more time for some questions. I saw that a guy just raised his hands, but we can discuss after this event. So you basically described the ESM like the Mr. Wolf of Quentin Tarantino's Pulp Fiction. It's quite incredible, but it's right. So the fixer. So thank you all. Thank you again for our distinguished panelists. Thank you for your insights, and to all of you for being here for this event. Thank you again.
C'era lui che aveva alzato la mano. Sì, io posso fare anche la. Sì. La mia domanda era